for this type of counter trend trading for a couple of reasons. Number one, it forces me to have a very specific setup. In other words, I have to see momentum here. I have to see momentum here, and I have to see a lack of momentum here. There's really no subjectivity to it. Either because you can look at the market and see that there's no momentum right here. I mean, look at this. Those bars are just dead. But look at this. There's momentum right here. It's obvious. Right here, what happens? No momentum. The market just dies. What happens right here? Look at this. There's momentum. Okay? It's easy to identify once you get in the habit of looking for it. So, the market comes down, gets to the 786 retracement. Now, the key here is seeing the warning sign. Okay? Remember I talked about the warning sign. This big bar is going to give me pause, so I'm not just going to jump in here. Okay, but once I see that the market is slowed down, as an aggressive trade, when I see this candlestick reversal right there, that's when I will do, get rid of that. That's when I'll do the following. Let me go down to 15-minute bar. Let me scoot back over. Okay, this, give my pen back. This area right here is where we were seeing the reversal. So when I see the market is starting to slow down and it's getting near the 786 level, that's when I'll start looking for a 3-bar reversal on a 15-minute chart. Okay, on the small time frame. And this is something I'm not going to give it very much leeway. At the most, I'm going to give it to go down here on a stop. You know, even if this is only maybe 10 or 15 pips, I don't want to give it a whole lot of range, because the thinking here is the market has got to reverse, and it's got to reverse quickly. Okay, it's the same thing with a momentum type of trade. If I'm expecting a breakout above this line, I don't want to see this mess right here. I don't want to see the market break out and then come back down. That's a lack of momentum. So I want to see the market make a reversal very quickly. I'm going to use a time-based stop. Okay, so if the market hasn't moved in 30 or at the very most 40 minutes, I just get out. And this is why the time of the day is important. If you see these setups during the key times, which would be around the London Open, which is about 3:30 to about 4. Whoops, that's supposed to be a 4 a.m. Eastern Standard Time, or I guess it'd be Eastern Daylight Time now. If you see these kind of setups around 3 to 4 a.m., the reason why it's more significant is, again, let's focus on the practical stuff here. If there are a lot of players in the marketplace and there are order after order after order coming in and it can't break through support, what does that tell you? It tells you that at the highest point of activity, there aren't enough sellers to break support. That's a key piece of information. That's why the time of the day is so very important. Get the pen back. The other time of the day would be between 9 and 10 a.m. Eastern. The reason why is because at 10 a.m. you have options expiring. Every single day, 10 a.m. Eastern Standard Time, Eastern Daylight Time, options are expiring. By 11:30 a.m., you have London traders going home. Man, that's really sloppy. Sorry about that. So these are all critical times. Again, when you see this stuff happening around these times, this is when we can exploit what's going on in the marketplace. So, and I'll make this very obvious because I've been getting some questions along this line as well. I don't believe as a day trader that I need to sit in front of the screen all day, because there aren't other traders in front of the screen all day. Sure, there's opportunity and you can make a case for it, but listen, most of the business gets transacted around the open and the close of any single market. So there's no reason to focus outside of that.